The Sensex and the Nifty slipped into the red within minutes of the finance minister beginning her budget speech. By the closing bell, the Wall Street had recorded one of its weakest budget day performances in recent years. The Sensex fell 1,547 points to close at 80,723. The Nifty dropped 495 points to end at 24,825. The trigger was clear. Budget 2026 raised the securities transaction tax on futures and options. So what exactly is this tax that rattled the market? And what does the hike mean if you trade or invest? Let's break it down. Securities transaction tax or STT is charged on every market trade, whether you make a profit or a loss. It is deducted upfront on each buy or sell order. Introduced in 2004, STT was designed to curb speculation and make tax collection simpler. Now, it's being used again to rein in aggressive trading. Under Budget 2026, futures and options trading has become costlier. Here is what changed. STT on futures has been raised from 0.02% to 0.05%. STT on options premium has gone up from 0.1% to 0.15%. STT on options exercise has also been increased to 0.15%. Now these numbers may look small, but in high volume trading, they add up very quickly. So why did the markets fall? Because futures and options account for a large share of daily market volumes. These are derivative contracts, not actual shares. Futures lock in a price for a later date, options give the right but not the obligation to buy or sell. They can amplify gains, but they also magnify losses. That is why even a marginal rise in transaction costs matters. When trading becomes more expensive, activity tends to slow. Liquidity tightens and prices react almost instantly. Now, there are three key reasons behind the move. First, to curb excessive speculation. Regulators have repeatedly pointed out that most retail FnO traders end up losing money. Second, to raise revenue from a derivatives market that has expanded rapidly. And third, to nudge retail investors back towards cash equities and away from high-risk leveraged trades. The biggest hit is to frequent traders. For instance, a 1 lakh rupees futures trade earlier attracted 20 rupees as STT. That now rises to 50 rupees. One trade may not matter much, but for traders executing dozens or hundreds of trades a day, these costs can quickly eat into profits. For long-term investors, the direct impact is limited. If derivatives are used only for hedging, the higher STT is not a major deterrent. However, there is an indirect risk. Lower derivatives activity can reduce overall market liquidity, and that can increase volatility even for investors who stick to cash equities. Supporters argue that unchecked speculation needed to be curbed. Critics warn that higher costs could push trading activity to cheaper global markets. Whether this move cools excesses or hurts market depth will only become clear over time. Follow Business Standard for more budget-related stories.